out here seeing this great project. My name is Dorne, Vice President of Sales at RCN Capital. We specialize mostly in 1 to 4 family real estate investing, either being fix and flip type business or even rentals for like 30-year loans, things like that. I want to get into the project here. So specifically for this one, you can hopefully see the little bit smaller font there. Sorry about that. A lot of information to get in here. Our classic kind of product for this particular type of project, what you call an after repair value loan or rehab loan. And so typically for our customers, if you have at least 3 properties of experience in your background, we can go up to 90% of the purchase price, 100% of the rehab cost, with a maximum loan size of 75% of the after repair value, which is exactly what we wound up doing on this house. Very typical type of loan that we get. And right now, this is really a great market to be fixing and flipping in. Softening of the market here leads for opportunities for investors. So despite what you hear in the news and things like that, there's always an opportunity in the market. And as the rates are rising, those rental properties might be a little less desirable, a little bit harder to cash flow. So fixing and flipping can really come in as a better strategy here. And as an investor, you got to be willing to adapt to whatever's best for that particular project. So this project, as Martin kind of highlighted for us, $680,000 purchase price, about $130,000 in rehab ARV at the time of $990. So again, simple, straightforward. We're taking 90% of the purchase price, which was $612, 100% of the rehab cost, $130,100. So max loan here came out to $742,100. A couple of key things about the way these loans work, right? These are bridge loans. These are short-term loans for this type of a project. So it's going to be 12 months basically to execute. If you got a larger project, you can go out 18 or 24 months even. But the borrower's only going to pay interest on the portion of the loan that they're actually using at any one time. So for the rehab money, you're not paying interest on that until you actually draw it down. And so for those draws as needed, the investors can start their project, they get going with the project, they start the demo, maybe some of the mechanical work and things like that, and they can reach out to us, request a draw, and then we will advance them funds from the $130,100 that we set aside at the closing table. That money then gets recycled into the project, and the borrower keeps going along, making the renovations, taking draws as they need it. So critical point there is that despite your project costs overall, I think your interest calculation, Martin, that we're actually using might have actually been on the high side of the estimates, because the balance of the loan actually increases over time. So when they're starting out, they're only paying interest on the $612, and it's not until they start taking draw money that payment's going to rise. So it's a big difference in how you manage your project, because it also has an impact on how you manage your costs, right? So we have some investors who will get into a project, they have their own money for the rehab, and so they'll save the interest cost by using their own funds to rehab the project. Then when it's all done, they come to us, they get one lump sum draw, and now that money that they've used to reimburse themselves is their down payment for their next project while this one waits to sell. So there's different strategies you can employ as an investor that can maybe offset some of your costs and set you up for your next project, where you, instead of having to wait for this one to actually close. So people will take a different tack to it depending on what their needs are and what kind of assets they have available to themselves. But there's not one way to do this. And I think that's some of the things that Martin was talking about, and Tom's certainly going to talk about as well. So during the life of the loan, the borrower's only going to make interest-only payments on it. They're responsible for making their own payments for the insurance and the taxes. Generally, people are going to pay the insurance up front on a lump sum basis for the entire 12 months, but some people will go with a shorter policy if they need to. But basically, the loan itself is going to get paid off only when they either sell the property or they refinance it out into a longer-term piece of debt. And so during that time, the interest-only payments for each month make it very manageable for them to keep the project going and not have to be coming out of pocket with heavy cash payments that would impact principal over time. So as a lender, I wanted to give a little bit of insight into some of the things that we're really looking for to help qualify people for a rehab loan. And really what you should expect to see from your lender and what you should expect to provide to your lender as you go into things. So it's really important for us to understand as a lender, what the scope of your project is, what the plans are, what your exit strategy is going to be for the loan, whether you're going to be selling, whether you're going to be holding on to it as a rental and cash flowing it. In this case, it's converting to condos, right? It's important that we get that narrative story that really tells us what's going to happen with the project to better understand where the risk is going to be with such a project, right? We see a lot of deals that come into our queues. Not all of them are perfect. Plenty of people will submit a deal that we have to tell them no because you're going to lose money. It happens. And so it's important to really understand what Martin broke down there, which is like the hidden costs that people don't always calculate, right? the cost of holding the property, your monthly cost for utilities, for insurance, taxes, things like that, that a lot of people maybe aren't factoring into their numbers. A lot of people are going to factor in the purchase price, their rehab costs, maybe some of their closing costs, but they might